Warren Buffett just did something that sent shockwaves through Wall Street. He sold over $50 billion worth of Apple stock, half of his entire position, gone. And when the greatest investor of all time, a man who has preached buying and holding forever, suddenly dumps his favorite stock at this scale, you need to pay attention. Because Warren Buffett does not make moves like this without a reason. And today, I am going to break down exactly what happened, why he did it, and most importantly, what this means for your money. Let me put this into perspective for you. Warren Buffett has been investing for over 70 years. He bought his first stock in 1942 when he was just 11 years old. Since then, he has seen every market crash, every bubble, every economic cycle you can imagine. The Great Depression aftermath, the Kennedy slide of 1962, the brutal bear market of 1973 to 74, Black Monday in 1987, the dot-com collapse, the 2008 financial crisis, the COVID crash of 2020. He has seen it all and come out ahead every single time. And in all that time, he has built a reputation for being the ultimate buy and hold investor. He famously said his favorite holding period is forever. He has talked endlessly about the power of compounding, about finding wonderful businesses at fair prices and holding them for decades, about ignoring short-term market noise and focusing on long-term business fundamentals. So when a man like that sells half of what was his largest position, a stock he has called one of the best businesses in the world, something significant is happening, something we need to understand. Now, before we dive into the why, let me give you the full context of what is happening in the markets right now. Because this move does not exist in a vacuum. We are sitting at a very interesting moment in financial history. The stock market has been hitting all-time highs. The S&P 500 has been on a remarkable run. Valuations on many stocks are stretched to levels we have not seen since the dot-com bubble of the late 1990s. The Shiller P/E ratio, which measures stock prices relative to 10 years of earnings adjusted for inflation, is sitting at levels that historically have preceded poor returns for investors. Interest rates, while starting to come down, are still elevated compared to the zero-rate environment we had for over a decade. For years, investors could not earn anything on cash or bonds. That pushed everyone into stocks. But now, you can earn over 5% on treasury bills with zero risk. That changes the math for every investment. At the same time, there is growing uncertainty everywhere you look. Uncertainty about the economy. Is it heading for a soft landing or a recession? Uncertainty about geopolitics. Conflicts in multiple regions. Trade tensions between major powers. Uncertainty about artificial intelligence and how it will reshape industries. Uncertainty about government debt levels that keep growing with no end in sight. And here is what makes this moment even more interesting. Berkshire Hathaway, Buffett's company, is sitting on a record cash pile. We are talking about over $325 billion in cash and short-term treasury bills. That is more cash than Berkshire has ever held in its entire history. To put that in perspective, that cash pile is larger than the total market capitalization of most companies in the S&P 500. It is a staggering amount of dry powder. And that cash pile keeps growing quarter after quarter as Buffett continues to sell stocks and refrain from making major purchases. So ask yourself this. Why would the world's greatest investor be raising cash at record levels while selling his best-performing stock? That is the question we need to answer. And the answer could have profound implications for how you manage your own money. Let me walk you through exactly what Buffett did. According to Berkshire Hathaway's 13F filings with the Securities and Exchange Commission, Buffett began reducing his Apple position in the first quarter of 2024. At that point, Berkshire owned around 905 million shares of Apple, worth approximately $170 billion. It was by far the largest position in Berkshire's portfolio. By the end of the second quarter, That position had been cut roughly in half, to about 400 million shares. That represents a sale of over $50 billion worth of Apple stock in just 6 months. And the selling did not stop there. In subsequent quarters, Berkshire continued to trim the position. Each quarterly filing showed fewer Apple shares. Each filing showed more cash on the balance sheet. The pattern was unmistakable. Buffett was systematically reducing his exposure to his favorite stock. Now here is what makes this even more remarkable. Apple was not just any position for Berkshire. It was the position. At its peak, Apple represented nearly 50% of Berkshire's entire stock portfolio. Think about that for a moment. Here is a company that owns stakes in dozens of businesses: Coca-Cola, American Express, Bank of America, Chevron, Occidental Petroleum. And yet, half of all the stock market value in that portfolio was in a single company, Apple. Buffett had called Apple the best business in the world. In shareholder meetings and interviews, he talked about it with genuine admiration. He said he viewed it not as a stock, but as a business he owned a piece of. He talked about the incredible ecosystem that Apple has built. How once someone buys an iPhone, they get AirPods, then an Apple Watch, then a MacBook. Then they subscribe to iCloud and Apple Music and Apple TV+. He marveled at the brand loyalty. How customers line up to buy the latest products. How the switching costs are so high that once people are in the Apple ecosystem, they rarely leave. He praised the cash generation. Apple produces over $100 billion in operating cash flow every year. It returns massive amounts to shareholders through dividends and buybacks. He even said he wished he owned 100% of Apple instead of just 5%. So what changed? Why would he sell half of something he loved so much? Why would he turn his back on a company he called the best business in the world? Let me break down the likely reasons based on what we know about Buffett's thinking, his past statements, and the principles he has followed throughout his career. The first and most obvious reason is valuation. This is fundamental to everything Buffett does. He has always said that price is what you pay. Value is what you get. Even the best business in the world can become a bad investment if you pay too much for it. When Buffett first started buying Apple in 2016, the stock was trading at around 10 to 12 times earnings. Wall Street was skeptical of Apple at the time. People worried that the iPhone had peaked. That competition from Samsung and Chinese manufacturers would eat into market share. That Apple was just a hardware company dependent on product cycles. The stock was cheap relative to its earnings power. Fast forward to today, and Apple trades at closer to 30 times earnings. That is a massive expansion in valuation. The business has not tripled in quality, but the price has tripled relative to earnings. And Buffett has always been clear that he wants a margin of safety in his investments. He wants to pay significantly less than what a business is worth, so that even if things go wrong, he still comes out okay. At 30 times earnings, there is much less margin of safety. The stock would need to continue growing at exceptional rates just to justify its current price. Any disappointment, any slowdown in growth, any misstep could lead to a significant decline. By selling at these levels, Buffett has locked in enormous gains and reduced his exposure to potential downside. Now, Buffett did not sell his entire Apple position, which tells us he still believes in the business. But selling half at these valuations suggests he thinks the easy money has been made. The stock has already gone up massively from where he bought it. The risk-reward has changed. The second reason is likely related to taxes. This might sound boring, but it is actually a very big deal, and it gives us insight into how Buffett thinks strategically. When Buffett sold those Apple shares, Berkshire had to pay capital gains taxes on the profits. Berkshire had accumulated gains of roughly $65 billion on its Apple investment. Selling half meant realizing tens of billions in taxable gains. Here is where it gets interesting. In his annual letter to shareholders, Buffett made a point of discussing taxes. He noted that corporate tax rates are at historically low levels right now at 21%. This rate was set by the Tax Cuts and Jobs Act of 2017. But he also pointed out that given the massive government deficits, tax rates are almost certainly going to rise in the future. Think about what that means. The United States government is running deficits of around $2 trillion per year. The national debt is over $34 trillion and climbing. At some point, the government needs more revenue. And one of the easiest ways to raise revenue is to increase corporate tax rates. If you have a huge unrealized gain like Berkshire had on Apple, and you believe tax rates are going up, it actually makes sense to realize some of those gains now and pay taxes at the current lower rate rather than wait and potentially pay a higher rate later. Buffett essentially locked in his gains at a 21% tax rate. If corporate taxes go up to 25 or 28%, which many analysts expect could happen in the coming years, he saved Berkshire billions of dollars in future tax liability. This is the kind of strategic thinking that separates Buffett from ordinary investors. He is not just thinking about the stock price today, he is thinking about the tax landscape years from now. The third reason is portfolio concentration risk. Having 50% of your stock portfolio in a single company, no matter how good that company is, creates risk. What if something unexpected happens to Apple? What if there is a major product failure? What if a new competitor emerges with a revolutionary technology? What if regulation hits the tech sector hard? What if there's a geopolitical event that disrupts Apple's supply chain in China? What if consumer preferences change? These are all unlikely scenarios individually. But over a long time horizon, the probability of something going wrong increases. By reducing the position to something closer to 25 or 30% of the portfolio, Buffett has reduced that concentration risk while still maintaining significant exposure to a company he believes in. He has also freed up capital that can be deployed elsewhere when opportunities arise. Diversification is not just about spreading risk. It is about having the flexibility to take advantage of new opportunities. The fourth reason, and this is the one that should make you pay the most attention, is that Buffett appears to be preparing for something. When you look at the totality of his moves, it tells a story. He is selling stocks. Not just Apple, but other positions too. He is raising cash at a record pace. He is buying short-term treasury bills that are paying 5% yields. He is not deploying that capital into new investments despite having over $300 billion available. Why would the world's greatest capital allocator choose to earn 5% in treasuries rather than invest in stocks? This is a man who has spent 70 years finding undervalued businesses and buying them. Suddenly he cannot find anything worth buying? The most logical explanation is that he sees better opportunities ahead. And the only way you get better opportunities in the stock market is if prices come down. Buffett has said many times that he likes to be greedy when others are fearful and fearful when others are greedy. Right now, with markets at all-time highs, with valuations stretched, with speculation in meme stocks and cryptocurrencies, others are greedy. And Buffett appears to be getting cautious. He is not predicting a crash. He has always said he has no ability to predict short-term market movements. But he is positioning himself to take advantage if prices do come down. That is a very different thing. Now let me give you some historical context, because Buffett has done things like this before, and the results are instructive. In 1969, Buffett closed his investment partnership and returned money to investors. He told them he could not find bargains in the market. At the time, markets were expensive. The go-go era of the 1960s had pushed valuations to elevated levels. People thought he was crazy for walking away. Over the next 5 years, from 1969 to 1974, stocks fell nearly 50%. The S&P 500 lost half its value. Buffett was right to be cautious. His investors were grateful he returned their money. In the late 1990s, during the dot-com bubble, Buffett refused to buy technology stocks. People mocked him. Wall Street analysts said he was out of touch. He was a dinosaur who did not understand the new economy. Berkshire's stock underperformed. Investors questioned whether he had lost his edge. Then the bubble burst. The Nasdaq fell nearly 80% from its peak. Companies that were valued at billions went to zero. Investors who had chased technology stocks lost everything. And Buffett's caution was vindicated. Berkshire came through relatively unscathed and was able to buy quality businesses at depressed prices. In 2007 and 2008, Buffett was sitting on a large cash position. Critics said he was leaving money on the table. Why hold cash, earning almost nothing when the stock market keeps going up? Then the financial crisis hit. Lehman Brothers collapsed. The banking system nearly failed. Stocks crashed 40% or more, and Buffett was able to make legendary investments. He invested $5 billion in Goldman Sachs at incredibly favorable terms. He put $3 billion into General Electric. He made deals that generated billions in profits for Berkshire. His patience and his cash gave him opportunities that no one else had. While others were forced to sell at the worst possible time, Buffett was buying. The pattern here is clear. When Buffett raises cash and becomes cautious, it often precedes difficult times in the market. He is not always right on timing. Sometimes he is early by years, but his instinct to raise cash when markets are expensive has served him well over and over again. So what does all of this mean for you? Let me break it down in practical terms. First, this is a signal to evaluate your own portfolio concentration. If Warren Buffett, with all his resources and expertise, thinks it is prudent to reduce a 50% position down to a more manageable level, what does that tell you about your own portfolio? Do you have too much of your wealth concentrated in a single stock or a single sector? Many people today have massive exposure to technology stocks, either directly or through index funds. The S&P 500 itself is now heavily weighted toward a handful of tech giants. If you own an S&P 500 index fund, you might have 30% or more of your money in just 7 or 8 companies. That might be worth examining. Second, this is a reminder that valuation matters. It is easy to get caught up in the story of a great company and forget about price. Apple is a wonderful business. Nobody is disputing that. But even wonderful businesses can be poor investments if you overpay. Buffett paid 10 to 12 times earnings for Apple. Would you feel comfortable paying 30 times earnings for the same business? At some point, the price you pay determines your returns, regardless of how good the underlying company is. As Buffett himself has said, you pay a high price for a cheery consensus. Third, this is a lesson about the importance of having cash available. Everyone wants to be fully invested all the time because holding cash feels like you are missing out. When markets are going up, cash feels like a drag on your portfolio. But cash gives you options. Cash gives you the ability to take advantage of opportunities when they arise. If the market drops 20 or 30% next year, the people who have cash will be able to buy quality assets at depressed prices. The people who are fully invested will just be watching their portfolios decline and hoping for a recovery. Having some dry powder is not about timing the market. It is about being prepared for opportunity. Fourth, consider the tax implications of your own investments. Buffett clearly thinks about taxes strategically. He is not just thinking about pre-tax returns. He is thinking about what he gets to keep after taxes. If you have large unrealized gains and you believe tax rates might increase in the future, it might be worth considering whether to realize some of those gains now. This is especially relevant for people approaching retirement who might want to do some tax planning. A conversation with a tax professional could be valuable. Fifth, pay attention to what the smart money is doing, not what they are saying. There are plenty of Wall Street analysts who will tell you to buy stocks all day long. That is how they make their money. But watch what the most successful investors actually do with their own capital. Buffett is not telling you to sell everything and go to cash, but his actions speak loudly. He is raising cash at a record pace. He is reducing his exposure to his favorite stock. He is earning 5% in treasury bills rather than chasing returns in an expensive market. Actions reveal beliefs more clearly than words. Now let me talk about some specific things you can think about with this information. First, take an honest look at your portfolio allocation. Write down what percentage of your portfolio is in each position. If any single stock represents more than 15 or 20% of your portfolio, that might be too concentrated. Consider whether you want to trim some positions to manage risk. Second, think about your time horizon. If you are young and investing for decades, market volatility does not matter as much. You can afford to ride out downturns. Time is on your side. But if you are approaching retirement or already retired, you need to think differently. Can you afford a 30 or 40% drawdown? How would that affect your plans? If the answer makes you uncomfortable, that might be a sign you need to be more conservative. Third, consider building a cash reserve. Not your emergency fund, but an investment reserve. Money that you could deploy if the market gives you an opportunity. Even having 5 or 10% of your portfolio in cash or short-term treasuries gives you flexibility. And right now, you can earn over 5% on that cash. So you are being paid to be patient. Fourth, do not try to time the market, but do pay attention to valuations. You do not need to sell everything and wait for a crash. That is a losing strategy because you might wait forever and miss gains in the meantime. But you can be more selective about what you buy and at what price. You can be patient rather than chasing stocks that have already run up significantly. Fifth, remember that this is a marathon, not a sprint. Buffett has been investing for over 70 years. His success comes from patience, discipline, and avoiding major mistakes. He does not try to maximize every single year. He tries to compound at a reasonable rate over decades while avoiding permanent losses of capital. That mindset is worth adopting. Let me leave you with one final thought. Warren Buffett selling half his Apple position does not mean you should panic and sell everything. It does not mean a crash is coming tomorrow. It does not mean Apple is suddenly a bad company. What it does mean is that the greatest investor of our time, a man with access to information and resources most of us can only dream of, has looked at the current environment and decided that raising cash and reducing exposure makes sense. That is information worth considering. Not blindly following, but considering. Because when Warren Buffett makes a move this significant, it usually tells us something about the environment we are in. And the environment we are in right now appears to be one where caution and patience might be rewarded. Keep watching Berkshire's quarterly filings. Keep tracking how that cash pile grows or shrinks. Keep paying attention to what the smart money is doing. Because if Buffett starts deploying that $300 billion in cash, that will be a signal too. A signal that he sees opportunity. And when Warren Buffett sees opportunity, history suggests you want to pay very close attention.